In 1973, the U.S. stock market collapsed by nearly 50%, wiping out trillions in paper wealth. The so-called Nifty 50, a club of corporate titans like Polaroid, Xerox, and Coca-Cola, had traded at an average price-to-earnings ratio of 42, while the broader market sat near 15. Investors believed those blue-chip giants were untouchable. They were wrong. Today, history is whispering the same tune. The Magnificent Seven, Apple, Microsoft, Amazon, Nvidia, Google, Meta, and Tesla, now make up more than one-third of the S&P 500's total value, the most concentrated level since the early 1970 seconds. The names have changed. The illusion hasn't. Every generation believes it has mastered risk. Every era thinks its growth story is different. Yet when speculation hides behind innovation, the result is always the same. A silent bubble built on faith, liquidity, and leverage. And this time, the silence is louder. The financial world moves in cycles: optimism, excess, collapse, amnesia, and rebirth. But hidden beneath these patterns lies something darker, a recurring architecture of control. Behind the booms and busts stand the same forces: central banks, debt markets, and the myth of endless expansion reshaping wealth and power each time the cycle resets. The surface story is easy to see: soaring stock charts, record earnings, AI optimism. But the real story is unfolding quietly in balance sheets, credit flows, and policy meetings. The kind that never makes the headlines until it's too late. To understand why it's happening again and why almost nobody is talking about it, we need to go back in time. Back to the late 1960 seconds. The age of prosperity, confidence, and a dangerous faith in permanence. The year was 1968. America was booming. Factories were full, wages were rising, and Wall Street was drowning in optimism. The Dow Jones had climbed above 1,000 points for the first time, a psychological milestone that felt like destiny. Investors called it the New Era. A generation of money managers, flush with pension fund cash and post-war confidence, believed that the great American corporations could never fail. They poured billions into a handful of names: IBM, Polaroid, Xerox, Johnson & Johnson, Coca-Cola. The financial press crowned them the Nifty 50. These weren't just companies. They were symbols. Xerox was the office of the future. Polaroid was instant innovation. IBM was the brain of modern business. And behind them stood a belief system that technology and brand power made them immune to downturns. The numbers told a different story. By 1972, the Nifty 50's average P/E ratio soared past 40, more than double the market average. Investors didn't see risk, they saw inevitability. The narrative was simple: buy and never sell. The higher prices went, the more they believed they were right. Meanwhile, beneath the glow of prosperity, the foundations were shifting. U.S. spending on the Vietnam War and Great Society programs exploded, budget deficits widened, inflation crept higher, and foreign central banks, once happy to hold dollars, began to demand gold instead. In August 1971, President Richard Nixon made a fateful move, closing the gold window, ending the dollar's convertibility to gold. It was the quiet death of the Bretton Woods system that had anchored the global economy since 1944. Overnight, the dollar became just paper, and that paper was now everywhere. Markets cheered the move, liquidity flowed freely, the Nifty 50 soared to even more absurd valuations. But something fragile had been created, an economy detached from its anchor, powered by confidence alone. The stage was set. All it needed was a spark. It began in October 1973. The Yom Kippur War erupted, and with it, an economic weapon the world had never seen before. The OPEC oil embargo cut supplies to the United States and its allies, sending oil prices soaring from $3 to nearly $12 a barrel in months. Energy became a political weapon, and inflation turned from a warning into a wildfire. At first, Wall Street tried to ignore it. Analysts still clung to their charts and projections, convinced the Nifty 50 would defy gravity. But reality broke through the ticker tape. Within a year, the Dow Jones Industrial Average lost nearly half its value, falling from 1,051 to 577 points. The collapse erased almost a decade of gains. Investors who had preached buy and hold forever were suddenly silent. Polaroid, once the darling of innovation, plunged more than 90% from its peak. Avon fell by over 80%. Even the mighty Coca-Cola, a supposed safe haven, dropped more than 50%. Pension funds, university endowments, and ordinary retirees watched their fortunes vaporize. But this was more than a market correction. It was the end of an illusion, the belief that paper wealth could expand endlessly while real value stood still. Inflation hit 11% in 1974. Interest rates spiked. The cost of living soared. For the first time since World War II, faith in the American economic model began to crack. President Nixon had already resigned under the shadow of Watergate. His successor, Gerald Ford, tried to calm the panic with buttons reading, "Whip inflation now." But no slogan could reverse a decade of debt and dollar expansion. To most observers, the story ended there. A painful bear market, a lesson in valuation excess. But beneath the headlines, something deeper was changing the very machinery of money itself. A new system was quietly taking shape, one that no longer needed gold, one that could create liquidity out of nothing, and one that would eventually power the greatest financial bubbles in history. When Nixon severed the dollar from gold in 1971, he didn't just close a window. He opened a vault, one that could print reality itself. For the first time in modern history, money was no longer backed by metal, production, or limits. It was backed by confidence and the ability of central banks to conjure liquidity whenever the system trembled. This shift created what economists would later call the fiat era. But to the financial elite, it was something far more powerful, control without constraint. The collapse of the Nifty 50 wasn't just a stock market tragedy. It was the first major test of this new order. As equities imploded, policymakers discovered a hidden weapon, the ability to manufacture rescue. The Federal Reserve, under Chairman Arthur Burns, slashed rates and expanded the money supply to contain the panic. For the first time, markets learned that pain would be temporary if policy moved fast enough. That lesson became doctrine. Each crisis, the 1987 crash, the 1998 long-term capital management bailout, the 2008 global meltdown, and even the 2020 pandemic intervention followed the same pattern. Liquidity crisis, central bank rescue, larger debt base, and an even greater bubble waiting at the end. Money became policy. Policy became psychology. And psychology became the market. The hidden mechanism wasn't greed or corruption alone, it was systemic addiction. Every rescue required more liquidity than the last. Every rate cut pushed the next crisis closer. By 2021, global debt had surpassed $300 trillion, triple the level of 2000. The same principle that saved the system was now threatening to consume it. And the parallels to the 1970 seconds were impossible to ignore. Back then, the concentration was in the Nifty 50. Today, it's in the Magnificent Seven, holding more sway over indices than any group of companies in history. Back then, inflation broke the illusion. Today, the illusion depends on debt-fueled growth and monetary alchemy, a cycle that can't last forever. The surface story says technology and innovation are driving this boom. The hidden truth, the same machinery of easy money and concentrated power, is humming louder than ever, and this time, it's global. 50 years later, the same forces are moving again. Different names, same story. In 2024, the world's 7 largest tech giants, Apple, Microsoft, Amazon, Nvidia, Alphabet, Meta, and Tesla, controlled nearly 36% of the S&P 500's total value. Their combined market cap was larger than the GDP of China. Just as the Nifty 50 once defined the new era of the 1970 seconds, these digital empires define our own. Investors chant a familiar creed: they can't fail, they're the future. Meanwhile, beneath the glittering surface, debt has reached record highs. Global public and private liabilities exceed $315 trillion, the equivalent of more than 330% of world GDP. Central banks, trapped by years of low rates, can no longer tighten without breaking the fragile balance they built. Each policy pivot buys time, not safety. Each bailout preserves confidence, not solvency. History isn't a straight line. It's a loop tightening, turning, repeating. In 1973, inflation and overconfidence destroyed the illusion of endless growth. In 2008, leverage and complexity brought the system to its knees. Now, once again, markets float on a tide of cheap money and concentrated power, one tremor away from revealing how hollow the foundation has become. And the price will not be paid by the architects of the system. It will be paid by workers whose savings evaporate with inflation, by families whose homes rise faster than their wages, by nations whose debt chains them to the very system that exploits them. The pattern has never changed. Wealth concentrates, risk socializes, and the cycle resets a little higher, a little louder, a little more dangerous each time. They told us it was progress. They told us it was prosperity. But history whispers a different truth. It's happening again, and almost nobody's talking about it.